Hey guys, what's happening? Jay here, smarthelping.com. Man, I love doing these models. So today I have a hydrogen plant financial model. It's to look at a single plant, look at all the unit economics of it over up to 20 years, revenues, expenses, construction, debt, all that stuff. And the idea is, well, if you can make one plant profitable, then you know the recipe to make multiple plants profitable, and really this is going to be a function of your feedstock costs, your electricity, water costs, and some of the things that are required to get the hydrogen from your raw materials. So here we go. Um, we'll start on the global control tab and I'll explain each tab as we go. This does have full three-statement model, income statement, balance sheet, cash flow statement. It has executive summaries, IRR, discounted cash flow analysis. I do have an option for a joint venture if you're raising money through a GP-LP structure or just an agreement between two parties, mainly one operator, one providing a lot of the money. Visuals and monthly and annual details over here. So let's get into it. Global control tab, couple simple inputs. Name of the company, this will go on the top of financial statements. How long you want to forecast for, up to 240 months, which is 20 years. You could do anything in here. You could do 60 months, 36 months, 120, 180 for 15 years, whatever you want. This will define when everything stops. And then when it does stop, you can choose to have an exit value or not, yes or no. And it'll be based on a multiple of the trailing 12-month revenue from the stop month. Now, these months, the model is completely arbitrary as far as it's just starting with month numbers. You can assign any date you want to this, whatever it might be. So that's completely flexible. The key is the model's running on a 1 through 240 month timeline. For the exit value, it doesn't mean you're necessarily going to exit, but for proper discounted cash flow analysis and to get a value of what the business might be worth at the end of the forecast period, generally people will put in an exit value. Cash sources is populated on other tabs, but this is a summary of that, what you're raising in debt versus equity, and then corporate tax rate, and then a general project level return summary, internal rate of return, investment requirement, total cash returned, equity multiple, and ROI. All right, construction tab. I put some general costs here that I found in research about building a plant. Equipment, land, constructing the building, all that stuff you can put in here. You can separate the different useful lives if you want. This will all apply to depreciation expenses over time. And you could put in your costs here by month if the costs happen over time, or all in 1 month, or whatever you want to model. You can do it here with the construction costs. Depreciation tab works automatically. The revenue tab is quite comprehensive. So here we're going to figure out how much hydrogen are we possibly able to produce in 1 month. So you can put that down in column C. This is generally just the maximum capacity of the plant. It wouldn't change unless you did expansions in the future. But that's the maximum capacity. Then you got your capacity utilization rate. This is how much of the maximum that you can produce are you actually producing. This is going to drive a lot of your costs, variable costs. And then you have a yield factor to say some of what you produce will never be sold because of waste, leakage, what have you. So then of whatever you do produce, this percentage is telling you how much you're actually selling of what's produced. So these three define your hydrogen production and yield. Now, what we have is three customer types you can model. And I just thought of the highest level. So industrial, transportation customers, and energy storage customers. And you could define of what you're producing, the percentage that's going to industrial, transportation, and energy storage. Now I've just set these equal to what's above it. So you could change these however you see fit. They should all add up to 100% in here, here, and here when you add up these three columns, F, J, and N. you can adjust them if you want. I've just made it easy so if you change the top number, all the bottom numbers change, but that's if you want to adjust these over time, you can, and that's fine. It'll just break the formula here, but it doesn't break anything else in the model. It's just whatever you populate and the month number for the percentage for these three, that's how much hydrogen is going to be allocated to that customer, and it'll go through all the other logic. Now within a given customer type, you can also define, so there's three types of hydrogen. And this is the main type from my research that I found: gray, blue, and green. Gray is less nature friendly. Green is obviously, it's called green because it's more friendly, and blue is kind of in the middle. And all three of them have different assumptions for what you can charge for it per kilogram, as well as what it costs to produce, which we'll get into all of those things. So basically, we've got three customer segments that you're selling to, and then within each customer segment, you've got three types of hydrogen that could be being sold. Now we have here our three types of customers and the price we're charging each customer per kilogram sold for gray, blue, and green. So gray, here's the three customer types, how much we're charging for gray for industrial transportation versus energy. For blue, how much are we charging for industrial customers that are getting blue, and so on. Green, three types. Now these prices you can set at the beginning and then set an annual price change. You could manually change these columns if you wanted. Right now I've set everything to 0% increase for revenue and cost, but let's say you put in, 2.5% here, then every year the price will go up by 2.5% for this one. Put this back to 0. Over here, we actually have so you can see we differentiated what is being sold by customer type and segment and hydrogen type, but we don't know what's produced by type, and that's the production is key for variable cost, because even though you don't sell all of it, it's going to cost you a certain amount to make it. So you have to know what you're actually producing, which is going to be a function of these first two rows, not counting the yield factor. And that's going to drive your variable costs. So what this does over here is separate it out so we know, you can see the formula here, we're just multiplying this times this, so how much are we producing, and then times the percentage going to transportation, and then of that, how much is gray. And that's because you're going to have you're going to need to differentiate for these different segments when we actually figure out the math in the monthly pro forma. So we have those calculations there. This still always adds up. So this is 750,000, which will match. You can see in month one over here, we are totally utilizing 750,000 of our max 3 million. So that number is broken down there, and it will go to figure out the cost here for gray, blue, and green for variable cost, which we'll get into in a bit. Okay, so that is the revenue tab. Very dynamic. Adjust all the assumptions over a 20-year period, and three customer segments. Each customer segment has three types of hydrogen that can be sold. Pricing accordingly. And the reason why this price can vary is you might have bulk industrial orders where you're charging less, and maybe energy storage customers you're charging more, but they're getting less quantity or what have you. Opex. So for Opex, the top sections are going to be for fixed costs, and you could actually put in the annual cost here, the annualized cost of each of these types, and you can adjust what that annual cost is over the 20-year period, if it goes up or down or stops or what have you. You can adjust here for the start month of when the cost actually begins in the model. And these would be things for rent, insurance for equipment, insurance for the plant, the building, legal costs, accounting costs, things that don't really change a whole lot with the change in production. So just your operating costs fixed. And we have G&A and R&D, a bunch of different sections here. And note that this is separate from staffing. So these are like non-staff, all of this. We have a separate tab for staffing costs, which have potential for payroll tax and benefits. And again, this is going to be their annual salary, which you can adjust each year. And then you could do the start month of the staff type, how many you're going to have, and the annual salary. And that all populates here if you go down to the monthly detail. So here's the fixed operating costs. And then the staffing section here, 168 goes down, and you can see that we're dividing that total amount by 12. And each row, this includes the payroll tax and benefits calculation over on the end here. But let me get down to the variable costs here. So if you go down to the Opex, you do have a section for costs as a percentage of total revenue to kind of hit anything else that you missed or want to fill in there. But the really bottom up part of this is your variable costs. This took me the longest to build, to research, understand, so I knew the relationships and how to build this. So for example, we have gray, blue, and green hydrogen. And for each one, we want to try to figure out, this is what we're trying to get to, the total cost per kilogram of hydrogen produced. What is it costing us? So for example, the first one here, we have feedstock for gray hydrogen. So gray hydrogen is made through steam methane reforming. Well, that's one method, which means natural gas is your feedstock. And we want to know how much natural gas do we consume to produce 1 kilogram of hydrogen. In this case, we're putting our assumption at 5.9. And we're assuming it's 5.9 through the entire model, but you can change that too if efficiency goes down, or there could be different reasons why, but normally it'll just be the same. That's this row. Then you got to plug in your price of natural gas. Here we're doing the cost per kilogram of natural gas. Now you'll see a lot of calculations measure it in MMBTU, I think they call it. But basically there's roughly, I think 26 kilograms per unit of measure on that one. So I've converted it and figured out roughly what's a decent cost here per kilogram of natural gas, but this is going to be vary by region, how you might produce your own natural gas, but that input is to figure out what your natural gas is costing to produce your gray hydrogen. The final calculation down here is just multiplying, the amount you need of hydrogen or natural gas to produce a kilogram of hydrogen times the cost per kilogram of natural gas. So we're saying, okay, to produce 1 kilogram of gray natural gas is going to cost 66 cents in natural gas per kilogram. We also have the water, and water we're just doing cost per cubic meter or liter. Whatever the case, you want to make sure the units are the same with these two. So in this case, let's say it's 9 liters and each liter costs 0.002 cents. And so this is our water cost per kilogram of hydrogen, gray hydrogen. Electricity, same thing. We're doing in kilowatts. So how many kilowatts is required to produce 1 kilogram of hydrogen times your electricity cost. And then so that'll scale up based on how much hydrogen you're producing prior to the yield calculation. So remember, this is just how much you're producing in kilograms, and so this is cost per kilogram here. And then we have two other more simplistic calculations, catalyst and compression storage. So here we're just hard coding in a cost per kilogram of hydrogen for these two, and those will just get added to the other calculations we've done that are a little bit more detailed. And then you can adjust the price of these each year if you want. I've set everything to 0, but like if this is 1%, okay, now everything's going up by 1%, and you can adjust these over time as well. Let me see, did I make sure I touched on all of this? Yeah, and you can adjust pricing of your electricity, water, and natural gas over time with these percentages. Okay, so that's gray hydrogen. We figured out it costs about $1.12 to produce 1 kilogram of gray hydrogen based on all of these assumptions. And again, assumptions are key. This is what you're going to be researching and understanding at the plant location that you're building at. Blue hydrogen, a little bit different, mainly because of this carbon capture storage area. But the other parts, so it's going to take natural gas as feedstock, similar as above, electricity, water, a catalyst, and then we also have compression storage. But this other one is new carbon capture and storage, so that's you're saying how many kilograms of CO2 is captured for every kilogram of hydrogen produced. So we can, again, we're denominating because we know how much hydrogen we're producing. So we're saying for every, in this case, 10 kilograms of hydrogen produced, we're producing kilograms of CO2 captured for every kilogram of hydrogen produced. So 10 kilograms, and then we're converting kilograms to, we know the cost per ton of CO2 captured, so we're saying it's $50 to capture a ton of CO2. And we're converting kilograms to tons in this calculation here to figure out what's our actual cost, carbon capture cost / storage for each kilogram of hydrogen produced. So it's $50 a ton. We're producing 10 kilograms for every one. There's a conversion of kilograms to tons here. It's 0.00110231. And so we get 55 cents a kilogram. Compression storage, same as above. And again, you can adjust all your pricing over time for blue. So blue is a little bit more expensive, $1.70 to produce a kilogram. And then green is supposed to be, in theory, the most expensive, usually because it takes a ton of electricity. You're doing, I can't remember what it's called, I think electrolysis or something, where you've got a lot of electricity per kilogram of hydrogen produced. Here we're saying 52 kilowatts. So it's going to depend on your cost per kilowatt here at 5 cents. You know, if let's say it was more around the US prices at, 13, or it depends. It depends on the area, it depends on the time as well. These prices go up and down. That could vary widely, but if that was higher, 13 cents versus 5, you're looking at $7 a kilogram versus these other ones, which are quite a bit lower. Now, again, we do have an assumption as well here for energy, for electricity, and the amount needed for gray and blue. But since they're using natural gas as their main feedstock, they don't require as much electricity. Here, it's all electricity, water, and then you got compression, purification, other costs. So again, it depends on your assumptions. We'll put this back down to 5, or put it to 5. But usually green is more expensive. And you could source your electricity through renewable energy sources as well, but that's could be more expensive, even more so. And this is why, because there's these different costs, this is why I've got different pricing inputs for the different types of hydrogen, as well as to different customers. Okay, so that's your main 3 types of hydrogen, all those variable costs there you can configure. You have other costs here, so this is mainly for transportation or distribution, and I just put as flat $1 per kilogram produced, and this applies evenly to all of these, just as an average. So we're looking at the total kilograms produced times this amount for your transportation. And again, you can adjust that price over time. So now that you've got all your revenue input, you've got all your Opex, you've got staffing expectations, we have loan here. Now this loan 1 is for the construction. It doesn't have to be a construction loan with interest only. It could be a straight up, we could turn interest only off. And in that case, if you have interest only off, all your costs that you're drawing on that construction tab here need to be in month 1, or need to be in the first month of whatever. It just has to be all in 1 month, whatever that month is. And then you'll just have a regular P&L loan, principal and interest loan from that start month. Now, if we have interest on, and let's say, this might be if you're drawing on it over time and your interest changes, and there's, let's say, a 12-month interest only period, okay, and then it converts to a P&I loan at some point in the future, you can define all your terms here. How much of those construction costs are being financed with this loan, the loan term when it switches to P&I, the rate on that, and then you have here if you want to do IO loan on or off, and then interest only period. You could also pick to accrue interest or not. If yes, you can see here there's actually no payments being made. This is just accruing to the balance, and then when you switch over, you'll do a P&I loan based on whatever balance there is. If you don't accrue interest, then you're going to have an interest expense here. You can see the P&I principal and interest went down because we're not adding that to the balance. And then the interest only rate. So your interest only rate is different usually than your P&I rate. So pretty flexible. You got some options here for financing some of the construction with debt, and the cost of that debt can be defined here. You've also got two other loans. These might be for equipment or just working capital or what have you, and these are more simplistic where you just have an amount, the loan term, interest rate. Payment for a year should always be 12, and the draw month. So this loan could happen in, here we have it in month 5, so you can see on the monthly detail, and month 5 we have both of those loans happening, and then the next month you've got principal and interest. The construction loan is a little bit different, but we have all that logic here. For the draw, the principal and interest starting after the interest only period. Here's interest only, and then the accrued interest is a non-cash item, but we do have it here to account for proper calculations on the balance sheet for that debt. So that's your loans. Other initial costs. So here, if you have one-time future CapEx purchases that you don't want to put on the construction schedule for whatever reason, and no, these are all subject to the financing percentage. All these costs on the construction tab are subject to this percentage. If you have costs that you don't want to finance, you could put them here and just define the month number and the amount, useful life, and that will be depreciable items. You've also got other costs that are non-depreciable. This could be initial legal costs, what have you. These all happen in the very first period. Okay, well, that's all the assumptions. Now we get into income statement. So here's our monthly and annual income statement. You can see our sales by hydrogen type, total sales, total revenue, direct costs. So based on all those different assumptions for the different types, we have feedstock costs, electricity, water, catalysts, carbon capture, compression purification, transportation, total direct costs, and then we can see what our gross profit is. Revenues minus variable costs, and then we have our operating costs, EBITDA, interest, depreciation, taxable income, income tax, and net income per year. So income statement, monthly and annual, same data, just on an annual view versus monthly. Your balance sheet is basically going to show you cash, fixed assets based on your CapEx, accumulated depreciation, which starts based on when this starts, and this is dynamic, so this logic knows when you switch from not having a capacity to having some number, and that will drive when depreciation starts on the balance sheet, accumulated depreciation. Your debt over time, equity invested, and then retained earnings. And our assets always equal liabilities plus owner's equity, and there is our check for that. What's nice about this is you can adjust all these different assumptions, and these financial statements will change and always balance. Here's your annual view, you got your cash flow statement annual, and then we go into executive summary annual. This is kind of like the income statement, but I've also included the other cash flow items to get all the way to cash flow and an IRR of the project, as well as some ROI equity multiple. Discounted cash flow analysis is just showing you, so this model is assuming the minimum cash that you need is all invested up front, whatever that is, and then you've got distributions over time or available cash output to measure the project's IRR. You can do a discounted cash flow analysis as well and see the cash flow here of the project. The joint venture, so this is if you want to split the contribution cost between maybe an investor and an operator, as well as split how the cash available is distributed, and it can be based on the internal rate of return achieved by the investor. And as in this case, this joint venture structure increases the share of cash flow to the operator. You can see here they're getting more and more GP as the internal rate of return goes up for the LP. So here all of that math is happening. You can see the amount split at each hurdle and the percentages, which will match these Here, in this case, we're giving 100% of the cash to the LP until they've received 10% IRR, which is what you see here. And then cash flows beyond that are now split at our promoted rates for the GP. You've got an IRR and an equity multiple for the LP here. Now, if the GP did contribute, you would have some numbers here for the GP as well for investment amount and IRR. We're just going to assume 100% for the LP for now. Visuals, we have total revenue, gross profit. These are all annual. EBITDA, cash flow, gross profit percentage. And again, these are all the same because I just chose to make everything 0% adjusted over time. So that's why these are all the same for every year. EBITDA changes a little bit because I've got fixed costs changing slightly over time, getting a little bit higher. You've got your monthly hydrogen yield, so the amount you're selling per month here. Monthly cumulative cash flow. There's your break even on equity rate around month 12 or, well, what is that, 15? Total assets versus liabilities, monthly view, annual view of assets versus liabilities. This is just, as you're making money, this is what happens, and your liabilities are going down as you pay off that debt. Average gross profit per kilogram sold. So here we're looking at the revenue versus those variable costs and breaking it down to a per kilogram basis and saying for every kilogram we sell, we're making $1.72 in gross profit. For every kilogram we produce, we're making $1.63. And again, the difference between these two is just simply a function of your yield factor. Now the yield factor might change over time. Maybe you get better at more efficient, less leakage. You sell more of what you're making as you get established customers, what have you. This percentage could change over time, which would affect the differential between these two. We've also got annual revenue by customer segment. So industrial, transportation, and energy storage customers. How much revenue in total are we getting is what this total bar shows, and then the breakdown by color is showing you of that how much is industrial versus transportation and energy storage, or whatever you define these. You can change these titles of these here and it will update through the model. We've got annual hydrogen yield, so the amount sold here, remember this is the amount sold by month. Here we're doing what's sold by year in kilograms of hydrogen. And then here we're showing what's the breakdown between gray, blue, and green hydrogen. So this is the same total bar as this, but you're seeing the breakdown. And then again, that all adjusts with the different assumptions. And I try to color these. I am colorblind red and green, but I can sort of get the colors right. So here I try to do gray as gray hydrogen, blue as blue, and green as green hydrogen for these ones that have the types. You've also got your annual gross profit by hydrogen type and annual revenue by hydrogen type. Now, our monthly detail, this is where you'll spend a lot of time trying to understand the model. So as you plug in the assumptions, they will fill in here by month all the way through to month 240, depending on how long you're running the forecast. And you can see every detail of how we're getting to, here's our maximum production, here's the amount produced, here's the amount sold. Here is the industrial sales by type. So you've got your gray, blue, and green hydrogen, the amount and the price you're selling for. Same with transportation, the amount of kilograms per month that you're selling and the total revenue of that based on the prices. Same thing for energy storage customers, and then you got your total hydrogen revenue. Here's where we're getting our total revenue per kilogram sold versus kilogram produced. Total revenue after, you might have renewable energy certificates or government subsidies that you could plug in here. Those are just hard-coded entries. Then we have our variable costs. Again, this was the most difficult thing to model and get all that logic correct. So you've got the total produced amount, and remember, produced is different than sold, so this is why we had to do that extra part on the revenue tab over here. So we have the total produced amount of kilograms, and then we have of what's produced for gray, we can see the cost per kilogram of feedstock, water, electricity, catalyst, and compression. Just taking that amount we've calculated on the other tab multiplied by the total here. And that we've got a total gray hydrogen cost, blue, same deal, and green, same deal. Then we have transportation as a function of the total produced up here, which is just the total will always be the same as these three summed up. Okay, then we have gross profit. We have, oh, here's an important one, your total cost or average cost per kilogram sold versus produced. So your revenue per kilogram should always be higher than your cost, or else you're going to be losing money. And then you get your gross profit is the differential. If this is negative, that's not good. That means for every kilogram you produce, you're losing money. Other costs are G&A, fixed operating costs, staffing, R&D. Then we've got our loans, principal, interest, total debt service, other costs, CapEx, taxes, exit proceeds, which don't happen until the final period if we are including an exit value. And then we get to cash flow and cumulative cash. This running cash position is what we use to figure out how much equity investment is required to keep the project above zero, and that's also why you see in the balance sheet, well, zero is what we're solving for, so we have a little bit of an excess here for the first few months as we have some operational burn, CapEx, what have you, and then we get to zero, but we never go below, and then you start saving money at that point. Now, you could plan for expansions or other costs that happen over time here, and as you build a cash balance, you could pay for that with this, or you would fund this with your operating cash flows over time. You could expand as you watch your cash balance grow. You see as we go to the right here, it's getting more and more. Or it could just be distributions to shareholders or what have you. Annual details, same deals to monthly, but you just see everything on an annual basis. Alrighty, and that's the full financial model. This is smarthelping.com. You can download the template in the link in the description box below. This is probably my last renewable energy model I'll do for a while unless I come across something interesting, but it will be included. So this model, I'll probably put it, well, obviously it's going to go in the, where's my renewable energy bundle. So here I've already done a hydropower, wind farm, biogas, EV charging stations, and solar panels. So I'll add it to here. We'll keep the bundle price for renewable energy financial models at $125. I think I'll charge $65 for the current model I just went over with you guys. So that'll be included in here. It'll also be included on the industry specific bundle. I've got tons of financial models in this that you can go through, but that'll be probably in the industrial section. And then as such, it'll also be included in this industrial financial model bundle, which has a few different things than the renewable energy. You've got construction in here, equipment rental, mining, single tenant industrial real estate, a couple different models. So it'll be included in that. And then finally, we will also include it in the Super Smart Bundle, which includes 200 plus financial models, all from the Smart Helping entire site. And this also includes Smart Helping Plus models, which are custom things I've done for clients of models I've built. So that's pretty interesting and valuable. You can see what other people are doing with the models that I've done. And I guess that's about it. If you need help, custom work, my rate for new clients is $275 an hour, and I'm usually available within 24 to 48 hours to build something or customize something. And this goes for building financial models from scratch, reviewing a financial model with you, explaining how it works, explaining how to fit your situation and scenario into it, and basically anything with Excel or Google Sheet modeling work. I do some data work in Google Sheets as well, not just financial models. So working with dashboards, looking at raw data, analyzing it. So let me know on that, and I will see you guys on the next one.